To understand how the market delivers price, you must first master the fair value gap. This is a specific three-candlestick pattern that reveals a fundamental flaw in the market's matching engine. When aggressive, institutional volume enters the arena, it creates a one-sided delivery of price where only buyers or only sellers are matched. Look at the sequence. A bullish fair value gap forms when the high of the first candle fails to touch the low of the third candle. This leaves a pristine structural void, a zone where price moved too fast, for the algorithm to offer a fair auction. The algorithm treats these inefficiencies like a vacuum. Because the market constantly seeks equilibrium, price is magnetically drawn back into these voids to re-auction the levels and heal the imbalance. But the true power of an imbalance becomes apparent when it fails. This brings us to the inversion fair value gap. An inversion is simply a traditional gap that has been completely disrespected and violated by the market. When the algorithm refuses to hold a zone it was mathematically supposed to defend, it signals a massive institutional shift. Imagine a bullish gap. If a massive bearish candle slices straight through it and closes below it, that failed support zone instantly transforms into a predatory resistance ceiling. Once you understand traditional and inverted imbalances, you can deploy time-based execution models. The most consistent is the silver bullet. This mechanic is engineered strictly around specific algorithmic volatility windows during the London and New York sessions. To execute the silver bullet, your chart must be perfectly synchronized with the clock. Wait for price to aggressively drive past the established session high or low, stripping away the buy-side liquidity where retail stop losses reside. The moment the algorithm clears these orders, it will rapidly reverse. This structural break confirms that demand has evaporated and institutional sellers are now driving the market. If you want to get a perfect execution, you need to combine the liquidity sweep with market structure shift, and your ideal entry zone is an unfilled fair value gap. Before we continue deeper into these algorithmic mechanics, let's address the biggest bottleneck most traders face: capital. If you are struggling to pass complex prop firm challenges, dealing with strict daily drawdown rules, there is a much faster route to the markets. Hola Prime offers instant funded accounts with absolutely no challenge phase required. You get immediate access to real trading capital from day one. If you want to bypass the evaluation phase entirely, check the official link in the description below or use the exclusive discount code on screen to secure your platform discount. Now, let's get straight back to the mechanics. Next is the turtle soup hunt. This model is engineered specifically to exploit classical retail support and resistance concepts. Retail textbooks teach traders to locate strong demand zones, buy the bounce, and place their stop losses just a few pips beneath that support line. To retail traders, this looks like safe risk management. To the institutional algorithm, this looks like a massive pool of liquidity waiting to be harvested. As a smart money trader, you do not buy the support level. You treat that line as an algorithmic trap. You patiently wait for price to violently break down through that floor, making it look like a genuine bearish breakout before aggressively reversing. The ideal setup for this model is to wait for a minor liquidity to form above a fresh fair value gap, because most retail traders will buy the pullback and set their stop losses just below that low. Our mission is to wait for that liquidity to be taken, enter at the close of the first engulfing candle, and wait for the money to get printed. Then we have candle range theory, or CRT. This advanced concept strips away the macro noise and focuses strictly on the internal liquidity dynamics of individual candlesticks. According to CRT, the absolute high and low of any given candle act as the most critical localized liquidity boundaries that subsequent candles will interact with. The strategy operates on a highly structured three-candle cycle: the range, the sweep, and the entry. To execute this model, mark the high and the low of the 1-hour candle. Drop down to the 5-minute time frame. Wait patiently until the market takes the liquidity. Wait patiently again until you see a strong market structure shift. Then take your trade. Your target will be the fresh, untouched liquidity on the other direction. Keep in mind that when applying this model, you should always follow the daily direction. If it is bullish, you only hunt for buys. If it is bearish, you only hunt for sells. But how do we calculate the exact mathematics of the discount? This is where institutional OTE, or optimal trade entry, comes into play. When a market expands aggressively upward, retail traders frequently suffer from fear of missing out, buying at the absolute top of the expansion. The algorithm routinely punishes this behavior by engineering a deep retracement to flush these early positions out before continuing the true trend. The optimal trade entry zone exists exclusively between the 0.618 and 0.786 levels, with the 0.705 midpoint acting as the ultimate sweet spot. The best way to execute this model is to put the order directly on the middle of the optimal zone. And if the zone overlaps with an active imbalance or supply area, that would be a double confirmation. But keep in mind that this strategy is a double-edged sword. It can give you a strong risk to reward ratio because your stop loss will always be tight. But it can also be risky because you're stepping in without confirmation. And you might get trapped in the wrong move, so if you want to avoid that, you must watch for the change in the state of delivery, or CISD. This is the absolute earliest technical warning sign that the institutional algorithm has flipped its internal program from a buy model to a sell model. When the market aggressively violates the exact level where institutions previously bought and initiated a trend, the state of delivery has fundamentally changed. The algorithm is no longer supporting higher prices. It has shifted into a premium sell program. Keep in mind that this concept cannot be used alone. You should use it as a confirmation inside other ICT models. Now, we conclude our playbook with the ultimate macro blueprint of institutional price delivery, the power of three, universally known as the AMD model. This concept breaks down the entire life cycle of market cycles into three strict operational phases: accumulation, manipulation, and distribution. During the accumulation phase, smart money quietly builds positions by trapping price inside a tight, boring consolidation range. Next, the algorithm initiates the manipulation phase. Price will execute a violent, incredibly fast breakout out of the accumulation box, tricking breakout retail traders into opening massive positions in the wrong direction. Once that mass liquidity is consumed, the real move begins, the distribution phase. Price violently reverses direction, tearing straight back through the accumulation range and expanding aggressively upward, leaving the retail world completely stranded. The best way to take advantage of this model is to wait an accumulation zone to appear. Usually accumulations happens at the Asian session, then you'll wait for the manipulation phase. After that, you seek a strong confirmation like the change in state of delivery before jumping in. Mastering these 8 mechanics turns you from a gambler into a market cartographer. You stop guessing where price is going, and you start seeing the algorithm map out its next move in advance.